Okay, so I know that gold should be rising. I mean, war is spreading. Tension is absolutely escalating. Oil is unstable. And yet, gold is falling. And it's not falling by a little. It's falling quite precipitously, quite worryingly. And you're right, that doesn't make any sense. Unless you understand, of course, the mechanism behind it all. What are we talking about here? We are talking about something other than just the normal safe haven status. Because this isn't just about war. It's about liquidity inside the system. But what do I mean by liquidity? I mean liquidity being more important than logic. Because in this financial system, liquidity is actually what runs the system. And most people are completely missing it. By the end of this video, however, you will be aware of what's really going on. So let's talk about it. So to understand it a little bit more, we need to be thinking about the textbook version of all of this versus what actually happens in the world versus the reality. Now, the textbook model always tells us that, one, firms make money. Firms generate revenue. And then we're told that investors evaluate the value. And then, of course, we are told that capital allocates to the best value. And obviously, henceforth, prices reflect fundamentals. Now, in all of those situations, that sounds completely logical. But that's not exactly what always happens. The reality is somewhat different. Let's go through what the reality actually is. The reality is what really matters. So it's more like this. Can the position be funded? Can it survive? What are the funding conditions? Is there a good rate environment? Is there a good risk appetite? And who can stomach the position? Who can sustain it? And what do our central banks do? How do they perform in this market? What do they do to contribute to all of it? Those are the key questions we need to be asking ourselves. So let me give you the simple version first. Countries are running out of dollars. So a few things are happening. They are being forced to sell their gold. They don't want to do that. No government wants to do it because they realize the writing's on the wall, but they are being forced to do it nonetheless. Not because they want to, but because they purely have to. Now, this has repeated itself in many, many different scenarios and many different iterations. But think of it a little bit like this. Let's use an analogy to really bring it home. If you suddenly need cash, let's talk about it in, I don't know, the 2008 crisis or in the 2020 crash. You don't sell your house first. You'd sell whatever you can sell quickly. And that means those things, like houses, are illiquid. They can't be sold quickly. But what can be sold quickly? Things like gold, things like equities, things like commodities. Those can all be sold. So for countries don't sell houses en masse, at least any scenario that I can envisage, but they do have reserve stores of gold. So that's what happens. They sell their gold. It happened in many, many other occasions, not just 2008, not just 2020, but in many, many iterations throughout history. Now, I've spent 20 years in financial markets, working in the City of London, in wealth, asset management, and also 20 years trading my own book. And this is the part of the system that most people never actually get to see. So what is the embedded confusion? Here's where most people get these things wrong. They're not asking themselves what the real question actually is. The real question is this asset good? That's the wrong question people ask. The question should be, can investors allocate capital here? Now, if you can answer those rudimentary questions, we can start to think about it a bit more logically. Imagine an example like this. A company has really strong earnings growth, really growing revenue, very strong outlook, a solid outlook even. Then interest rates start to rise significantly. Investors can now earn attractive returns in low-risk government bonds. So what happens? Well, obviously, the capital reallocates, not because the company deteriorated, but because the funding conditions completely changed. Now, this is where we have to talk about markets versus economic knowledge. Now, there is a bit of a gap between markets and actual economic knowledge, what we learn about in our textbooks and what's actually happening on the ground. So let's think about it in terms of previous examples. I mean, past is never prologue, but it does serve as a pattern that we can look out to. So let's imagine in 2008, long time ago, I know, but what happened in 2008 to the markets? Well, the markets didn't bottom when housing stabilized or when unemployment was ramped up. They didn't bottom at those periods of time. They bottomed when the Fed launched QE1 in March 2009, even as the economy remained in recession. And then what happened in 2020? Global GDP did something really strange. It contracted really sharply. Entire industries shut down. Industries collapsed. Many companies went bankrupt. Many people lost their jobs. Markets fell an astonishing 34% in 33 days. And then they recovered 100% and hit all-time new highs within just 12 months. The real economy, however, it lagged for years and years. Now, what was the signal in both of those scenarios? Now, in both of those scenarios, the turning point was never the economic data. It was something else. It was the change in liquidity conditions. So let's talk a little bit more about that. So people think war equals fear. Fear equals gold goes up. Simple, makes sense, methodical, I get it, I understand it. But markets don't actually run on logic. Markets run on something else. So markets are never running on logic. So what are they running on? They are running on liquidity. Markets run on liquidity. It's quite simple, really. And when the liquidity gets contracted or when it tightens and it can't flow, then everything below it completely changes. Now, let's use an analogy to bring this home. Let's imagine we have a bathtub. Let me break it down simply using a bathtub as the analogy. Imagine a country like a bathtub. This is my bathtub. I don't know what your bathtub looks like. Mine looks quite regal, apparently. That's the bathtub. Imagine that's a country. Dollars are what floats inside the bathtub. Apparently, I've got a transparent bathtub. You can see the liquid right through it. Dollars are what are the water in this analogy. Money comes in. Money's entering everywhere. We've got quite a rapacious bathtub, it seems. And money flows out. It comes in, it comes out, it passes through, it passes through, it passes in, it passes out. Now, normally, something interesting happens. Oil exports do what? Well, oil exports bring money in to our bathtub analogy. Trade and spending send the dollars out. So spending takes our dollars out of our bathtub. The system seems like it's in a delicate equilibrium. There's our fulcrum and it's balanced on it perfectly. Now, imagine this happens though. The tap begins to slow down and the drain opens even wider. In our analogy of our bathtub, what happens in that scenario? Well, that's exactly what happens in a war. And bear with me, because it's going to make sense. Let's add the numbers into this to really bring it home and help it to all make sense. So when we add the numbers in, this analogy becomes a bit more real, a bit more logical and less in the realm of abstractism. So when oil rises by, let's say, $10, so oil increases by $10, as the Americans call it, some countries need an extra 5 to 10 billion per year because they don't have oil. They're not producers of oil. They import their vast majority of their energy requirements. Now, imagine oil in this not so halcyonic world doesn't jump $10, it jumps $50. That's tens of billions of money that is now needed per year to be found. Not down the line, but immediately. And that leads us to the obvious problem. Now these countries, they all have a problem. These, UK, one of the most perilous, embattled ones in terms of energy. EU, Korea, China, especially Japan. They all need dollars, and they need those dollars absolutely yesterday. They need it fast, they don't want it tomorrow, they want it now. So they have a few choices. What are their three choices? In this scenario, they can do one. They can let their currency absolutely implode. Currency implodes. Currency goes down 10%. They can burn through their reserves, so they can use all the reserves that they've hopefully saved up because, all governments are prudential and very competent, or they can sell their assets. Now, which one do you think the country chooses? The country will not endure the pain of the currency imploding. They don't really want to use their reserve because it makes their creditability and their creditworthiness go down the drain. So they're going to always, invariably, sell their assets. They're going to sell their assets. Now, let me slow this down a little bit because this is entirely important. They are not bearish on gold per se. They are not changing their strategy per se. God forbid, that's not what they're doing. They are being forced to sell. They are forced sellers in this market. They don't want to sell, but they have to sell. Just like the thing that happens to retail traders and many institutional traders at that. Something happens to them that requires them to post more capital. It is the dreaded margin call, but on a sovereign level, if there is such a thing. Now, this is the mechanism that always happens. It goes something like this. Forced selling. Forced selling means forced liquidity selling. They need to raise that capital and they need to raise it fast. When the systems need that cash, they sell absolutely everything. And it's really that simple. But here is the key insight to all of those things. Because with the forced selling comes another inevitability. We have something called the downward pressure. Now, where does the downward pressure exert itself? It's going to exert itself downward, obviously, on the price of gold and the price of other assets. Even when everything says it should go up, even when the logic says that it should invariably go up, it won't go up. Something else happens. Let's expand it to the system level. Let's zoom out and look at it holistically. This isn't just one country in this system. This is happening across a multitude of countries all over the world. Energy importers. It's happening across countries where people need to raise liquidity really, really quickly. Our energy importers, our stressed buyers, are countries that need to raise money for armaments, countries at war, countries who need armaments. All of these people exert downward pressure, war-affected regions, dollar-dependent economies, energy importers, and at the same time, so what happens? What do you get? You get complete selling, simultaneous selling. You get dollars and their demand rising. People need to secure that cash and they need it yesterday. And concomitantly, they have gold reducing in price. And here's the uncomfortable part, if it wasn't uncomfortable enough already. This is not a bug in the system, boys and girls. Oh, no, no, no. This is how the system is purposely designed. It's designed to operate like this. So let me talk about another layer of complexity. Let's talk about another layer of how these central banks and how this system actually works. Because the global system runs on the dollar. Hate it or love it, that's the truth of it. It runs on the dollar. And when the stress hits, paradoxically, or not so paradoxically, after you've watched this video, you realize that everyone actually needs dollars. Everyone laments the dollar system, but they all need the dollar system. And they all need it at the exact same time, which is what really creates this incestuous, unvirtuous loop. And we're going to describe the loop on the trusty iPad here. What happens? Liquidity gets squeezed. I do apologize for my handwriting, it's abysmal. Which leads to more forced selling, of course. Selling begets selling, which begets selling, which begets selling, in a cascade waterfall-like scenario. And then our markets become absolutely distorted. And it seems very painful. It seems why the markets make no sense. It moves in such a nonsensical way, the opposite way in which people thought it would move immediately. So yes, do these markets move in the opposite way of common sense and logic? Of course, but it's because of the mechanism. Gold is falling during a war, which everyone and their uncle would probably tell you makes absolutely zero sense. But now that you understand the mechanism, it's not because gold is weak, it's because liquidity is really, really tight. And that's just the first layer of everything here. Liquidity being tight is the ultimate first layer, okay? So there's another deeper layer. There's a completely deeper layer to this that most people don't understand or care to even talk about. And this is precisely where it actually gets really, really interesting, actually. So listen on and pay attention, because forced selling doesn't last forever. It never does. Because we start to price in to reality, and eventually we will price it in and it will reflect in the gold price. What's particularly important is how the market forms a bottom. It doesn't occur when things stabilize. It doesn't occur when unemployment improves. It occurs when the Federal Reserve intervenes, or the ECB, or the BOJ, or the BOE, and it expands its balance sheet significantly through a variety of different measures. And what does that look like? It looks like this. Liquidity flooding back. So liquidity floods. Central banks save the day. Central banks provide largesse. I believe that's how you spell it. And money gets eventually printed. It always follows that same modus operandi. And then at that moment, absolutely everything reverses and you get a rip-roaring rally. Now, it's not the end of gold. What you're seeing right now, I know it looks like the end of gold, but it's definitely not. It's the system under pressure. It's the mechanism acting the way it's meant to act, the way it's designed to act. And stress always shows you something very, very important. It tells you what gets sold first. And now we know that that thing is gold. It also tells you what in our world of assets gets protected and what's seen as sacrosanct. It also tells you what's the most liquid thing out there. And it most importantly tells you where all of the pressure actually is. And as we can see, this is systemic level. Pressure doesn't just disappear overnight. It doesn't just go away. It doesn't just fail to exist, but it does definitely move. It moves on. And where does it go? It goes into the true safe haven asset. But if you know where it moves, if you know how the mechanism works, you can definitely protect yourself and even benefit from it. In some way, you can even be oracular, Delphic, and Nostradamus-esque and see what's going to happen next. But now, what's going to be happening now? What is the next move? You can see where the pressure leaks, but how do you know where we're going to be heading actually next? Well, it's all about liquidity dominance. I know that sounds like a terrible BDSM or S&M movie, but it's not. We've had liquidity dominance in times where the global economy shuts down, global shutdown. Or we've had it when the Fed promises unlimited QE. And now in all of those scenarios, these types of markets recover very, very quickly, even if the economy is still structurally broken. So you have an unemployment rate looking like this, but you have the markets looking like this, even though structurally we are still broken. We've seen it in COVID, we've seen it in other scenarios, in the GFC. All of these different scenarios lead to the same outcome. But before we end this video, let's talk about just how liquidity has overridden economic reality. Because in all honesty, economic reality no longer exists in the way you do. We always have a shock, and then we have the response. After that, we have our results. Now, let's imagine in this scenario, the shock is that GDP contracts. It goes negative. Maybe it's negative 0.5. The response, absolutely unlimited QE. QE to the power of 5. And then what's the result? Markets bottom. Now, obviously that makes complete sense because liquidity comes in and floods the system. How about the shock is different though? How about our shock is unemployment going above the Fed's mandated, 5%? What happens then? A $2.3 trillion stimulus, and that's not me making it up, that is literally the CARES Act. What happens then? The S&P recovers all losses by August 2020, within a few months. How about a shock like this? A 33-day bear market. What happens? The Fed expands its balance sheet again. 12 months, it expanded by 8 trillion in that scenario. What happens? New all-time highs, of course. And the last shock, S&P moves 34% down from the February highs. What happens in that scenario? Direct stimulus to households. And obviously we have a rip. Now, all of those things aren't academic. All of those things I just mentioned have all happened before. Now, all of those things happen for one quite simple reason. It's because liquidity comes in and it floods the system. And it always does. It's the exact same playbook as always. Nothing ever changes. So let's talk about something that's also misunderstood a little bit. The psychology, the narrative versus the mechanism. Now, in system 1, humans naturally seek cause and effect, which makes sense. We've evolved over many, many millennia to look for explanations of complex events, or even see patterns where patterns don't actually necessarily exist. That's called pareidolia, by the way, but that's for a narrow topic. We replace the probabilistic systems with intuitive narratives. What do we say to ourselves? We say markets fell because of war, but it rose on earnings. What's actually true in that scenario is this though. We construct those explanations after the fact, using a lot of recency bias. What's the problem with that? Obviously, the problem with that is that we're trading on old information, on psychological hubris, and on expectations that are extrapolated into the future that we have no actual idea about. Now, Soros spoke about reflexivity theory, which is that markets don't just actually reflect reality, they actually influence it, which is quite Heisenberg-esque in uncertainty and paradox of time and space and all of these other things, which is quite beautiful in a way. And participants' perceptions feed back into those market prices, which feed back into the real economy. So without going any further, the reason why gold is falling isn't logical if you don't understand the mechanism behind it. But when you realize it's all a function of liquidity, you start to realize that this is actually the playbook in every single so-called gold crash. And what happens a few months later? All-time highs. And it's not just gold, it's silver, it's other assets, financial assets, real assets, all across the spectrum. So if you've enjoyed my video, this is Justin in the House of Trade. Love to hear some feedback. Stay safe out there. Ciao for now.